I need to tell you something that I never thought I would say. For the first time in 20 years, I prefer holding cash over holding stocks. This is not a statement I make lightly. I've spent my entire career teaching people that being fully invested in productive assets is the path to building wealth. I've warned against market timing. I've criticized investors who hold too much cash and miss the compounding that creates fortunes. And yet here I am, telling you that right now, at this moment, cash is more attractive to me than stocks. Let me explain why I've reached this conclusion and what it means for how you should think about your own portfolio. This isn't about predicting a crash. It is about understanding the relationship between risk and return, and recognizing when that relationship has become so unfavorable that the traditional hierarchy of investments no longer applies. For most of my career, the choice between cash and stocks wasn't really a choice at all. Cash yielded essentially nothing. After inflation, holding cash meant losing purchasing power every year. Meanwhile, stocks offered the prospect of real returns, growth in wealth, that exceeded the erosion from inflation. The decision was obvious. Hold stocks for growth. Use cash only for liquidity needs and emergency reserves. Anyone holding significant cash for investment purposes was making a mistake. This framework made sense when cash yielded 1 or 2% and stocks offered prospective returns of 8 to 10%. The gap was enormous. You were giving up 6 to 8 percentage points of expected return by holding cash instead of stocks. Over decades, that gap compounds into life, changing differences in wealth. An investor who held cash instead of stocks during the great bull market missed out on one of the greatest wealth, building opportunities in history. But something has changed. Actually, two things have changed, and together they've altered the calculus fundamentally. The first change is that cash now yields something meaningful. After more than a decade of near-zero interest rates, short-term rates have normalized to levels that provide genuine return. Treasury bills yield over 5%. Money market funds yield similarly. High-quality short-term bonds yield even more. This isn't the zero return that made cash unattractive for so long. This is real yield, positive even after accounting for current inflation. The second change is that prospective stock returns have declined substantially. When stocks are expensive, as they are now, expected future returns are lower. This is simple math. If you pay a high price relative to earnings, your yield from those earnings is low. If you pay a high price relative to book value, your return on that equity is low. High prices today mean low returns tomorrow. This relationship has held throughout market history, and there is no reason to believe it is different now. Put these two changes together, and you get a remarkable situation. The expected return from stocks, after adjusting for the risk involved, is not much higher than the expected return from cash. Maybe stocks will return 6 or 7% annually over the next decade, if current valuations are any guide. Cash will return 5%, with essentially zero risk. The premium for taking equity risk, the additional return that compensates you for the volatility and uncertainty of stocks, has shrunk to almost nothing. This is why I prefer cash over stocks for the first time in 20 years. Not because cash has become wonderful, but because the relative attractiveness has shifted dramatically. The risk premium that justified holding stocks through their volatility has largely disappeared. Let me walk through this analysis in more detail because the conclusion is important enough to require rigorous support. Start with what cash offers today, a 6-month Treasury bill yields approximately 5.3% as I speak. This yield is essentially risk-free. The United States government will pay you back. There is no credit risk. There is minimal interest rate risk because the duration is so short. You'll receive your principal plus 5.3% annualized return with near certainty. This return exceeds inflation, which means you are earning a positive real return. Your purchasing power is increasing, not decreasing, by holding cash. This is a fundamental change from the environment of the past 15 years when holding cash guaranteed losing purchasing power to inflation. The optionality value of cash adds to its attractiveness. Cash allows you to take advantage of opportunities when they arise. If stocks decline significantly, you can buy at lower prices. If other opportunities emerge, you can act quickly. This optionality is valuable but hard to quantify. It is not included in the 5.3% yield, but it is real. Now consider what stocks offer. The current earnings yield on the S&P 500, which is earnings divided by price, is approximately 4%. This is what you are earning on your stock investment from current profits. Some of these earnings are paid out as dividends. currently about 1.3%. The rest is retained and theoretically reinvested to grow future earnings. If earnings grow at their historical average of around 5 to 6% annually, and if valuations remain constant, you'd expect total stock returns of roughly 9 to 10% over time. But there is a problem with this calculation. Current valuations are well above historical averages. If valuations revert even partially toward historical norms, returns will be lower, perhaps substantially lower. Various models of expected stock returns, using different approaches, mostly cluster around 6 to 8% for the next decade. Some are even lower. This isn't bearish speculation. It is the mathematical implication of high current valuations combined with reasonable assumptions about earnings growth and valuation normalization. So stocks might return 6 to 8% with substantial volatility and uncertainty. Cash returns 5% with near certainty. The gap has narrowed from the historical 6 to 8 percentage points to perhaps 1 to 3 percentage points. And that narrowed gap comes with all the risk of equity ownership, the volatility, the potential for significant loss, the uncertainty about outcomes. This is why the traditional preference for stocks over cash no longer applies in the current environment. The compensation for taking risk has become inadequate. You are not being paid enough to accept the volatility and uncertainty of stocks, when cash offers almost the same return with none of the risk. Let me address some objections to this analysis, because I know it challenges conventional wisdom. The first objection is that stocks always beat cash over the long term. This is historically true on average, but it obscures important nuances. The margin by which stocks beat cash varies enormously depending on starting valuations. When stocks are cheap, they beat cash by a lot. When stocks are expensive, they sometimes don't beat cash at all over meaningful time periods. From the peak in 2000, it took the stock market more than a decade to exceed what you could have earned in treasury bills over that period. Investors who bought stocks at the peak in 2000 would have been better off in cash for over 10 years. This isn't ancient history. It is recent enough that many current investors lived through it, the period from 1968 to 1980. Two is another example. Stocks went essentially nowhere for 14 years, while inflation eroded purchasing power. Cash, which yielded meaningful rates during much of this period, would have preserved purchasing power better than stocks. Starting valuations matter enormously. Current valuations are in the zone where stocks have historically struggled to beat cash over the subsequent decade. This doesn't mean stocks definitely will underperform cash. It means the historical assumption that stocks always beat cash doesn't apply when starting valuations are this elevated. The second objection is that you are trying to time the market, which doesn't work. This objection misunderstands what I am suggesting. I am not predicting when stocks will decline or by how much. I am not suggesting you sell everything and buy back at the bottom. I am observing that the risk-reward relationship has changed and that portfolio positioning should reflect this change. Recognizing that prospective returns are low and adjusting accordingly isn't market timing. It is investing based on valuations, which is what intelligent investors have always done. Benjamin Graham, the father of value investing, taught that you should be willing to hold more cash when stocks are expensive and more stocks when stocks are cheap. This isn't timing, it is discipline. The alternative, maintaining the same allocation regardless of valuations, means being equally aggressive when stocks are cheap and when they're expensive. This makes no sense. You are taking the same risk for very different levels of expected return. Risk-adjusted returns favor stocks when they're cheap and cash when they're expensive. Adjusting your allocation to reflect this is prudent investing, not market timing. The third objection is that cash has its own risks, particularly inflation. This is true over long periods. If you hold cash forever, inflation will erode its purchasing power. But this objection assumes that the choice is permanent. It is not. I am not suggesting you hold cash forever. I am suggesting you hold more cash now because the risk-reward favors it, with the intention of deploying that cash into stocks when risk-reward improves. The inflation risk of holding cash for a few years is modest compared to the potential loss from holding stocks during a significant decline. A few years of inflation might cost you 5 or 10% in purchasing power. A stock market decline could cost you 30 or 40 or 50%. The risks are not comparable. Moreover, current cash yields exceed current inflation. You are not losing purchasing power by holding cash right now. You are earning a positive real return. The inflation objection applied when cash yielded 0. It doesn't apply when cash yields 5% and inflation is 3%. The fourth objection is that I am being too pessimistic, that the economy is strong and stocks deserve their current valuations. Maybe. So, I don't know what the future holds, but even if the economy remains strong and earnings grow at healthy rates, the starting valuation still matters. You can have a wonderful economy and still have disappointing stock returns if you start from high enough valuations. Japan is the extreme example. The Japanese economy has performed reasonably well over the past 35 years. Japanese companies have remained innovative and profitable, but the Japanese stock market is still below its 1989 peak because that peak represented such extreme valuations. Starting valuations matter regardless of subsequent economic performance. Let me describe what preferring cash over stocks actually looks like in a portfolio, because the implementation matters as much as the concept. I am not suggesting you move to 100% cash. That would be extreme and would ignore the uncertainty inherent in all forecasting. What I am suggesting is that cash should represent a much larger portion of your portfolio than it normally would, instead of the minimal cash position that made sense when cash yielded nothing. Perhaps 20 or 30% in cash makes sense. Now, the specific allocation depends on your individual circumstances. Investors with longer time horizons and greater risk tolerance might hold less cash. Investors approaching retirement or with lower risk tolerance might hold more. But across the board, the allocation to cash should be higher than it was during the zero-rate era. The cash should be held in the highest, yielding safe instruments available. Treasury bills are ideal. They're backed by the full faith and credit of the United States government and currently yield over 5%. Money market funds that invest in government securities are nearly as safe with similar yields. Short-term Treasury notes provide slightly more yield with slightly more interest rate risk. Avoid reaching for yield in cash. Equivalent investments. Some money market funds hold commercial paper or other non-government securities that carry credit risk. The extra quarter point of yield isn't worth the risk during a credit crisis. Stick with government-only instruments. Consider the tax implications of your cash holdings. In taxable accounts, Treasury securities have state tax advantages because their interest is exempt from state income tax. In tax-advantaged accounts like IRAs, this distinction doesn't matter. Place your cash holdings where they're most tax efficient. For the portion of your portfolio that remains in stocks, emphasize quality and value. If you are going to take equity risk in an environment of low prospective returns, take it in stocks that offer better odds. High-quality companies with strong balance sheets and stable earnings are less risky than speculative growth companies. Value stocks with lower valuations offer better prospective returns than expensive growth stocks. Avoid the parts of the market that are most expensive and most dependent on continued favorable conditions. The mega-cap technology stocks that dominate the indices are priced for perfection. Any disappointment will be punished. The artificial intelligence darlings are priced for a future that may or may not materialize. These are not the places to take risk when the overall risk-reward is unfavorable. Let me discuss how you'll know when to shift back from cash to stocks, because preferring cash is not a permanent position. The preference for cash depends on the current relationship between cash yields and prospective stock returns. When this relationship changes, the preference should change too. There are two ways the relationship could change to favor stocks again. The first way is if cash yields decline substantially. If the Federal Reserve cuts interest rates back towards zero, cash will once again offer little return. The gap between stock returns and cash returns will widen, making stocks more attractive on a relative basis. This could happen if inflation falls and the economy weakens, prompting the Fed to ease policy. The second way is if stock valuations decline substantially. A significant market decline would lower the price you pay for future earnings, increasing prospective returns. If stocks fell 30 or 40%, the expected return from those lower prices would be much higher. The gap between stock returns and cash returns would widen from the stock side rather than the cash side. Either of these changes, or some combination, would shift the risk-reward back toward stocks. I am not predicting when or if these changes will occur. I am simply noting that the current preference for cash is based on current conditions. And when conditions change, the preference should change. This is an important point. Preferring cash over stocks doesn't mean being permanently bearish on stocks. It means recognizing that the relative attractiveness of cash and stocks varies over time. Right now, cash is relatively attractive. In the future, stocks may be relatively attractive again. The allocation should reflect the current reality, not a permanent view. Let me share some historical perspective on times when cash was preferable to stocks, because this situation is unusual but not unprecedented. The late 1960s and early 1970s were one such period. Stocks were expensive after the go years of the 60s. Interest rates were rising as inflation accelerated. Cash and bonds offered increasingly attractive yields, while stocks languished. An investor who shifted toward cash in 1968 or 1969 avoided much of the pain of the subsequent bear market and benefited from high cash yields. The late 1999 and 2000 period was another. Stocks were at extreme valuations, particularly in the technology sector. The Federal Reserve was raising rates, making cash more attractive. An investor who preferred cash in early 2000 avoided the dot-com crash and preserved capital for deployment at much lower prices. 2007 was similar in some ways. Stocks were expensive, though not as extreme as 2000. Cash and short-term bonds offered reasonable yields. An investor who moved toward cash in 2007 avoided much of the financial crisis losses. In each case, the shift to cash wasn't about predicting the exact timing of a crash. It was about recognizing that the risk-reward had shifted, that stocks were offering inadequate compensation for their risk relative to the safety and yield of cash. The investors who recognized this and acted accordingly protected their capital and were positioned to benefit when valuations eventually improved. The current environment shares characteristics with these historical periods. Valuations are elevated, though not as extreme as 2000. Interest rates are high enough to make cash competitive. The risk-reward for stocks is unfavorable. History suggests that preferring cash in this environment is prudent. Let me address the emotional difficulty of preferring cash over stocks, because the practical implementation requires overcoming psychological barriers. Holding significant cash feels wrong to most investors. We're trained to believe that being invested is always better than being uninvested. We're told that cash is trash, that it loses to inflation, that it represents missed opportunities. This conditioning makes it emotionally difficult to hold meaningful cash positions, even when the logic supports it. The emotional difficulty intensifies if stocks continue to rise after you've moved to cash. Watching others make money while you sit in cash triggers regret and fear of missing out. You'll question your decision. You'll be tempted to abandon cash and chase the market higher. Resist this temptation by remembering why you made the decision. The logic that supports preferring cash now doesn't become invalid just because stocks rose further. If anything, further rises from already elevated levels make the eventual reversion more likely and more severe. The decision to prefer cash is based on risk-reward analysis, not on predicting short-term price movements. Find ways to make holding cash psychologically easier. Focus on the yield you are receiving rather than the appreciation you are missing. 5% return with no risk is genuinely attractive. Frame cash as optionality rather than missed opportunity. You have the option to deploy that cash into stocks at any time, including at lower prices if they occur. Set rules for when you'll deploy the cash back into stocks. Having predetermined criteria removes some of the emotional difficulty. You are not deciding each day whether to hold cash or buy stocks. You are waiting for specific conditions that you've already decided would trigger action, except that you might be early. Preferring cash when stocks are expensive often means being early. The market can stay irrational longer than seems possible. Being early feels like being wrong, but it is not the same thing. Being early means you avoided some gains that you might have captured. Being wrong means your analysis was flawed. If your analysis is sound, being early is an acceptable cost. Let me share what I am doing with my own capital and the capital I manage for others, because I believe in demonstrating conviction through action. I've increased cash allocations across all portfolios I am responsible for. The specific percentages vary based on each portfolio's objectives and constraints, but the direction is consistent. More cash, less stock exposure, and within stocks, more emphasis on quality and value. I am maintaining this positioning despite the emotional difficulty. Yes, stocks have continued to rise in some periods. Yes, I've experienced the discomfort of watching others make money. but I believe the risk-reward supports this positioning, and I am unwilling to abandon discipline just because discipline is uncomfortable. I am also mentally prepared for this positioning to be wrong in the short term. The market might continue rising for months or years before any decline occurs. My cash might underperform stocks for an extended period. I've accepted this possibility and decided that the protection is worth the potential opportunity cost. When conditions change, I'll change my positioning. If stock valuations decline to levels that offer attractive prospective returns, I'll deploy cash into stocks. If cash yields decline to levels that no longer compete with stocks, I'll reduce cash allocations. The preference for cash is based on current conditions, and it will change when conditions change. After 50 years of investing, after watching cycles repeat and conditions evolve, I've learned that the relationship between risk and return is not constant. Sometimes risk is well compensated. Sometimes it is not. The skill of investing is recognizing which environment you are in and positioning accordingly. Right now, for the first time in 20 years, we're in an environment where risk is not well compensated. Stocks offer modest prospective returns with substantial risk. Cash offers similar returns with essentially no risk. The traditional preference for stocks over cash, which served investors well when cash yielded nothing, no longer applies. This is why I prefer cash over stocks. Not because I am bearish on the economy or predicting a crash, but because I understand risk and return, and I recognize when the relationship between them has changed, the current relationship favors cash. It is that simple. You don't have to agree with my conclusion. You can decide that the risk premium for stocks, even if diminished, is still worth taking. You can decide that your time horizon is long enough that current valuations don't matter. These are legitimate positions, and reasonable people can disagree. But you should understand the argument. You should recognize that the historical preference for stocks over cash was based on a yield gap that no longer exists in its previous form. You should acknowledge that high starting valuations have historically led to disappointing subsequent returns, and you should make your decision consciously based on analysis rather than habit. For me, the analysis points clearly toward preferring cash. For the first time in 20 years, I'd rather earn 5% with certainty than chase uncertain returns from expensive stocks. I'd rather have optionality than be fully invested. I'd rather protect capital than maximize exposure. This conclusion feels strange after a career of advocating for productive asset ownership, but conditions change, and conclusions should change with them. The analysis that made stocks obviously preferable to cash for most of my career no longer applies in the current environment. Recognizing this and acting accordingly is what investment discipline requires. Cash over stocks. For the first time in 20 years, because the risk-reward demands it, because the gap has closed, because protecting capital when risk is not compensated is more important than chasing returns. When returns are inadequate, that is my position, that is my reasoning, and that is why I believe preferring cash over stocks right now is the smartest decision an investor can make. Let me expand on some practical considerations for implementing this preference for cash, because the details matter as much as the concept don't. Question I receive frequently is whether this analysis applies to retirement accounts differently than taxable accounts. The answer is that the logic applies equally, but the implementation may differ. In retirement accounts, there are no tax consequences to repositioning. You can shift from stocks to cash and back without triggering capital gains. This flexibility makes it easier to act on the preference for cash and taxable accounts. You need to consider the tax cost of selling appreciated stock positions. If you have substantial unrealized gains, selling triggers tax that reduces your capital. This doesn't necessarily mean you shouldn't sell, but it does mean you should factor the tax cost into your decision. Sometimes the tax cost is worth paying to achieve better positioning. Sometimes it makes sense to hold appreciated positions while directing new money toward cash. For investors who are still accumulating, who are regularly adding to their portfolios through savings or retirement contributions, the implementation is straightforward. Direct new contributions toward cash until your allocation reaches the desired level. This allows you to build cash without selling existing positions. Avoiding tax consequences and transaction costs. Another practical consideration is where to hold your cash. I've mentioned treasury bills and government money market funds as ideal choices. Let me elaborate on the specific options and their trade-offs. Treasury bills are the purest form of risk-free cash. They're direct obligations of the United States government. So there is no intermediary credit risk. They're highly liquid, trading in enormous volumes every day. The interest is exempt from state income tax, which can add meaningfully to after-tax returns for investors in high-tax states. You can buy Treasury bills directly from the government, through Treasury Direct, or through any brokerage account. The main disadvantage of Treasury bills is that you need to manage rollovers. A 6-month Treasury bill matures in 6 months, and you need to reinvest the proceeds. This isn't difficult, but it does require some attention. Many investors find it easier to hold money market funds that handle the reinvestment automatically. Government money market funds invest in Treasury securities and repurchase agreements backed by Treasury securities. They provide essentially the same safety as direct Treasury ownership with automatic reinvestment. The yields are typically slightly lower than direct Treasury ownership because the fund charges a small expense ratio, but the convenience often justifies this cost. Be careful to distinguish government money market funds from prime money market funds. Prime funds can invest in commercial paper and other non-government securities that carry credit risk. During the 2008 financial crisis, a major prime money market fund broke the buck, meaning its net asset value fell below $1. This had never happened before with a major fund and caused panic among money market investors. Government only funds avoided this problem because their holdings carried no credit risk for amounts above the FDIC insurance limit. Bank deposits are not equivalent to Treasury securities. Banks can fail, and amounts above $250,000 are not insured during the 2008 crisis. And again during the regional bank stress of 2023, uninsured depositors faced potential losses. If you are holding significant cash, keep it in Treasury securities or government money market funds, not uninsured bank deposits. Let me discuss the psychological traps that make preferring cash difficult, because understanding these traps helps you avoid them. The first trap is recency bias. The recent past has rewarded stock investors handsomely. Those who held stocks through the pandemic crash were rewarded with rapid recovery and new highs. Those who held cash missed these gains. Recency bias makes us expect the recent past to continue. We assume stocks will keep outperforming cash because they have been outperforming cash. But recency bias is a trap. What worked in the recent past doesn't necessarily work in the future, especially when conditions have changed. The conditions that produce strong stock returns, low interest rates, expanding valuations, abundant liquidity, may not persist. Preferring cash requires overcoming the assumption that recent patterns will continue. The second trap is social proof. Most investors are fully invested in stocks. Financial media celebrates stock market gains. Investment professionals recommend staying invested. When everyone around you is doing something, it feels risky to do something different. Social proof makes us conform to the crowd. But the crowd is often wrong, especially at extremes. The crowd was fully invested in technology stocks in early 2000, just before the crash. The crowd was fully invested in financials and housing, related stocks in 2007, just before the financial crisis. Preferring cash when the crowd prefers stocks requires the courage to be different. The third trap is action bias. Holding cash feels passive. Investing in stocks feels active. We're wired to prefer action over inaction, to feel like we're doing something to improve our situation. Holding cash triggers discomfort because it feels like doing nothing. But holding cash is not doing nothing. It is making a deliberate choice based on analysis. It is positioning for a range of outcomes. It is maintaining optionality. Reframing cash as an active choice rather than passive inaction helps overcome action bias. The fourth trap is loss aversion applied incorrectly. We feel losses more intensely than equivalent gains. This normally makes us risk-averse, but in the context of cash versus stocks, loss aversion can work backwards. We fear the loss of missing stock gains more than we fear actual losses from stock declines. The potential regret of missing rallies feels more vivid than the potential pain of suffering declines. This is loss aversion applied incorrectly because it treats opportunity cost the same as actual loss. Missing gains is not the same as losing money. If you hold cash and stocks rise, you still have your cash. Your wealth hasn't declined. You've simply made less than you might have. This is categorically different from holding stocks that decline, where your actual wealth decreases. Recognizing this distinction helps overcome the misapplication of loss aversion. Let me address how the preference for cash interacts with other portfolio decisions. If you prefer cash over stocks, does that mean you should also prefer cash over bonds? Not necessarily. The analysis depends on the risk-reward of each asset class relative to cash. Currently, short-term Treasury securities offer yields similar to longer-term bonds, with much less risk. Long-term bond prices are vulnerable to further interest rate increases. So within fixed income, shorter duration is preferable. But intermediate-term bonds might offer enough additional yield to justify some interest rate risk, depending on your view of rate direction. What about international stocks? The analysis I presented focuses on U.S. stocks, which are the most expensive major market globally. International stocks, particularly in emerging markets and some developed markets outside the U.S., trade at lower valuations. The prospective returns from these markets may exceed the prospective returns from U.S. stocks. You might prefer some international stock exposure over cash, even while preferring cash over U.S. stocks. What about alternative investments like real estate, private equity, or hedge funds? These require separate analysis because their risk-reward profiles differ from public stocks. Some alternatives may offer attractive returns that exceed cash yields. Others may carry risks that are difficult to assess and not worth taking in the current environment. Don't assume that preferring cash over stocks means preferring cash over everything. What about gold and other commodities? These are often recommended as portfolio diversifiers and inflation hedges. Gold yields nothing, so it doesn't compete with cash on yield. Its value comes from diversification benefit and potential price appreciation. Whether to hold gold alongside cash depends on your views about inflation, currency stability, and geopolitical risk. It is a separate decision from the stocks versus cash preference. Let me share some thoughts on how long the preference for cash might persist, because this affects how you think about implementation. I don't know how long conditions will favor cash over stocks. The preference depends on the relationship between cash yields and prospective stock returns. This relationship could change quickly or persist for years. Several scenarios could unfold. In the first scenario, nothing changes dramatically. Cash yields remain around 5%. Stock valuations remain elevated. The preference for cash continues. This could persist for years, with cash providing steady returns while stocks deliver disappointing performance. Eventually, either cash yields fall or stock valuations fall, changing the relationship. In the second scenario, inflation accelerates and interest rates rise further. Cash yields increase to 6 or 7% or higher. Stock valuations decline as higher discount rates reduce the present value of future earnings. The preference for cash intensifies because both cash yields and stock risk-reward improve the case for cash. In the third scenario, economic weakness prompts the Federal Reserve to cut rates aggressively. Cash yields fall back towards zero. Stocks decline as earnings disappoint, but the declining cash yields make stocks more attractive on a relative basis. The preference for cash diminishes, and it becomes time to shift back towards stocks. In the fourth scenario, stocks decline significantly without economic weakness. A valuation reset occurs for reasons unrelated to earnings. This creates opportunity to buy stocks at lower valuations with higher prospective returns. Cash provides the dry powder to take advantage of this opportunity. I don't know which scenario will unfold. What I know is that the current preference for cash is based on current conditions, and it will change when conditions change. The implementation should be flexible enough to adapt as circumstances evolve. Let me conclude with some perspective on what this preference for cash means in the broader context of investment philosophy. Preferring cash over stocks doesn't mean abandoning the principles of long-term investing. It doesn't mean becoming a market timer or a trader. It means recognizing that the relative attractiveness of different assets changes over time, and that intelligent investors adjust their positioning to reflect these changes. Throughout my career, I've emphasized the importance of understanding where we are in the cycle. Cycles exist in economies, in credit, in psychology, and in valuations. Recognizing where we are in these cycles informs appropriate positioning. Playing offense when conditions favor offense, playing defense when conditions favor defense. Right now, conditions favor defense. The defensive posture that makes most sense is preferring cash over stocks. This isn't permanent. It is not a new investment philosophy. It is the application of consistent principles to current conditions. The investors who adjust their positioning based on conditions who become defensive when risks are elevated and offensive when opportunities are present tend to outperform those who maintain static approaches. The adjustments don't have to be dramatic or frequent. Simple shifts between more aggressive and more conservative allocations, executed at approximately the right times, compound into significant differences over decades. I've been investing for 50 years. I've seen multiple complete cycles. I've watched the relationship between cash and stocks shift back and forth. For most of this time, stocks offered clearly superior prospective returns that justified their risk. This is no longer the case. The gap has closed. The risk premium has shrunk. Cash competes with stocks for the first time in 20 years. This is an unusual situation, but unusual situations occur. The skill of investing is recognizing them and responding appropriately. Preferring cash over stocks right now is the appropriate response to current conditions. You don't have to follow my lead. You can decide that your circumstances are different, that your time horizon justifies staying fully invested, that you are willing to accept the risk for potentially higher returns. These are reasonable positions, but make the decision consciously, understand what you are choosing and why. Don't simply default to staying invested because that is what you've always done. The analysis points clearly toward preferring cash. For the first time in 20 years, the risk-reward favors sitting in safety over reaching for returns. I am acting on this analysis with my own capital. I believe it is the right decision for most investors in the current environment. Cash over stocks. It sounds strange after a career of advocating for productive asset ownership, but the numbers support it. The analysis supports it. And when analysis points in a direction that feels uncomfortable, that is often a sign you should follow it. Comfort usually comes from doing what is popular, and what is popular is rarely what is most profitable. Preferring cash right now isn't popular. It is prudent. And in investing, prudent beats popular over time. That is the lesson of 50 years. That is why I prefer cash over stocks for the first time in 20 years.